Hi, welcome back to Fi News, and before we dive into today's topic, don't forget to subscribe to our channel for latest in finance, tech, AI, crypto, and global affairs.
All right, today we're going to untangle a massive multi-trillion-dollar bet that Wall Street is making right now. And it all comes down to a single decision by the US Central Bank, the Federal Reserve. What's so wild is how this one decision connects pretty much everything, from the AI boom all the way down to the price of your mortgage. So what is this huge bet all about? Let's get into it. So it really boils down to this one question. Why are so many smart people with so much money on the line all laser focused on this one thing? Well, the answer reveals this really deep, interconnected web of economic forces, and get this, some of them are pulling in completely opposite directions. And the stakes, they could not be higher. I mean, just look at this number. As of late this year, investors were pricing in about an 80% chance that the Fed would do one very specific thing: cut interest rates. An 80% chance, that's basically the entire market screaming that it expects something to happen. But here's the thing. That bet completely ignores the brutal tug-of-war that's happening behind the scenes.
To really get what's going on, you have to understand the incredibly difficult spot the Fed is in. You can basically picture them walking a tightrope, trying to balance these two massive economic forces that are, well, pretty much at war with each other.
And this right here, this lays out the whole problem perfectly. On one hand, you've got the job market, and it's starting to look a little shaky. The unemployment rate is ticked up, and some key Fed officials are worried about a, quote, significant deterioration. That is a textbook reason to cut interest rates to give the economy a boost. But, on the other hand, inflation is still stubbornly high, running close to 3%. And that just screams, keep rates high to cool things down. They're getting two completely opposite signals at the exact same time. So, what do you do?
And this quote just shows you that even the experts on the inside are totally divided. It mentions dissents. You know, think of it like a Supreme Court ruling. When members of the Fed's big decision-making committee openly disagree with the group's final call, it's a really big deal. Getting 2 or 3 of those on a regular basis is almost unheard of. It just shows you how fractured things have become.
Okay, so as if that internal fight wasn't enough, there's this massive outside force that's just throwing a giant wrench into everything: the AI boom. And this isn't just about cool new tech. It's fundamentally changing the entire economic landscape that the Fed has to deal with.
And what that's created is something economists call a two-track economy. So in one track, you've got the AI and tech sector. It's like a bullet train, just fueled by insane amounts of investment. But the other track, for most other businesses, it's a slow, grinding crawl through higher costs and a ton of uncertainty. This makes it almost impossible for the Fed to come up with one single policy that actually works for everybody.
And wow, you can really see that split right here. The performance of AI-related stocks has been just astronomical compared to the rest of the market. This isn't one of those a rising tide lifts all boats situations. No, it's more like a geyser that's shooting a few select boats into the stratosphere while everyone else is kind of stuck in the mud. So what's actually fueling all this? It's not just buzzy software. I mean, sure, giants like Alphabet are soaring, but the real money, the big money, is pouring into the physical backbone of AI. We're talking data centers, energy, and computer chips. And this brings us to a really crucial point. So far, the AI boom has basically been about selling the picks and shovels for a new gold rush. The market is still waiting for someone to actually strike gold by using AI to become massively more productive.
Now, just when you think it can't get any more complicated, bam! The story has 2 really surprising twists that just go to show how interconnected all of this is, and how the obvious answer might be the wrong one.
First off, just look at this number, $90 billion. In just a few months, the big AI hyperscalers, the tech giants building all this infrastructure, they issued nearly $90 billion in corporate bonds. That is a staggering amount of money to borrow in such a short time. And that leads us to our first crazy twist. Okay, so this twist is all about a concept called crowding out. Now, just think of all the investment money in the world as water in a swimming pool. The usual fear is that huge government borrowing will drink that pool dry, right? Leaving none for private companies. But what if a massive private industry is the one drinking all the water?
And here's the punchline. The AI boom is so huge that these private companies might actually be crowding out the US government itself. Their massive demand for cash could be keeping long-term interest rates, the kind that affect your mortgage and your car loan, high, no matter what the Fed does with its short-term rate. So get this, AI's success could ironically be making your home loan more expensive.
And that brings us to the second surprising twist. And this one challenges the entire reason the Fed is fighting in the first place.
We all just assume the Fed is battling inflation that's coming from a hot economy. But what if the real cause of high prices is something else entirely?
Well, according to figures mentioned by the New York Fed president, tariffs could be adding as much as 3/4 of a percentage point to inflation all by themselves. On top of that, the absolutely voracious energy demand from AI data centers is pushing up electricity prices for everyone. So here's the crucial point. If tariffs and energy demand are the real culprits, then the Fed's main tool, raising interest rates, it's like using a hammer to fix a leaky pipe. It's the wrong tool for the job.
So where does all this leave us? I mean, we've got a divided Fed, a two-track economy, and all these surprising forces messing with interest rates and inflation. So what should we actually be watching for to make sense of all the headlines?
All right, here are 3 key things. First, keep an eye out for those Fed dissents. The more disagreement you see, the less certain the market is going to be. Second, track those long-term rates, like the 10-year Treasury yield. If the Fed cuts but those rates don't fall, that crowding out theory might actually be real. And finally, pay attention to the inflation blame game. If you start hearing more about tariffs and energy and less about the job market, that's a huge sign the whole narrative is shifting. And that leaves us with the ultimate question. Right now, our economy is being pulled in 2 different directions by 2 incredible forces: the world-changing power of AI innovation and the deliberate, heavy hand of Federal Reserve policy. They are in a direct tug of war, shaping our financial futures. And the big question we're left with is, which one is going to win?